the AI setup guide for futures and Forex, and soon for equities. We can do equities right now, but it really takes extra effort because the interface to the AI is not very friendly. And we've automated most of the Forex and the futures stuff, but not the equities. The equities are particularly more complex. And so that's why we don't put out as many equity calls. We put them out once in a while. And so what I want to do is talk a little bit, and what I do generally is I just talk to you. And then we'll go back, and then I'll tell you what I just told you, and then we'll talk about what I said. So what is the AI setups? What is it that is behind the scenes, and what are we doing here? We've concocted a service that we believe that is good for both new traders as well as professionals. And it's good for new traders because it teaches them the proper way of trading. And it's good for professionals because the alerts themselves, the quality of the alerts are friggin' awesome. And they already know how to trade. The real problem, the real reason or one of the primary reasons for this type of trading is for everybody else in between that has to be deprogrammed. And you wouldn't think that that's a problem, but it really is. It is a big problem. But most people, I would say that out of the 85 or so people that we have in the service right now that have subscribed, there's probably one or two that are still struggling with the concepts. And it's not the concepts of our service. It's their own problem with trading. And here's the thing, and this is what I want to, and this is a little bit different from every other training that I've ever done. And I want to start out this way to say that if you want to be an effective trader, you need to develop a philosophy. You need to develop these tenets that you follow. You need to develop a mantra that you're going to adhere to. And that mantra should be capital preservation first, profits second. So in other words, keep what you got. Now, one of the reasons why most people fail at trading is that they overextend themselves. They go too big. They take advantage of the leverage. They think that, oh, these things are awesome. I feel so strong, and I'm just going to put that trade on, and I don't care. I'll put on 5 contracts. And just so happens that would be the trade that out of, the 4 out of 5 trades that are profitable, that will be the one that isn't profitable. And then they'll really hurt their account. So the one thing, and this, all professional traders know this, if you want to sleep at night and keep trades on it overnight and not have to worry about them, then you should be trading as small as you possibly can. And I'll go over all the options for that too. You may wonder how you do that. Don't worry. We've figured this all out, and how you can make your position sizes as small as you can, and then also do some kind of calculation that will determine, well, what is my position size based on my account? When you have small sizes, when you have small position sizes, you don't need to fall into these tenets of trading that everybody else does, and trying to figure out risk and reward and all this other crap by setting tight stops that always gets them into a situation where they lose more often than they win. Often you get stopped out of a trade only for that trade to go maybe a little further down and then come right back and then make fantastic profits, but you're out of the trade now. That happens to everybody, not just to you, to everybody. And the reason why they get out is because they over leverage, and they have to get out. They can't afford to lose that much. But let's say that you could afford to lose it, and you could give the trade time to work out. Then you could sit back, watch. If it goes against you, no big deal. comes back, you make money. I'm not saying they're all going to come back and make money, but the fact is that more than 80% of our trades within the time frame that we allot, that 4 days after or within a 5-day period, come back and are profitable. Many are profitable right off the bat. But if you're over leveraged and you can't take hundreds of dollars or even thousands of dollars of drawdown, then you're going to get out. You're going to get scared. But if you have a very small trade on and you're down, 20, 30, maybe 100, maybe a couple $100, it's not like, and that's a couple hundred is a lot. Then you're not so worried because you know that that thing could turn around and turn into a $500, $1,000, or $1,500 winner. Now, I'm not promising that that's what all the trades are. I'm giving you the stats. The stats are that 80% of the trades that trigger, 80% of the trades that actually set up, and I'll explain all this, don't worry about it, are profitable. Now, what do I mean by profitable? Profitable means that they made more than $1. All right? And you say, well, making $1, that's nothing. But the but to that is that also 70% of those trades hit the target, which is substantial. Either they hit the target or they go beyond the target, right? So that means that there's a small percentage that don't make as much as the target, but most of them hit the target or go beyond it. So those are the facts. Those are the stats of how it performs. And the way it does that is that those are criteria that we give to the AI, that we tell it that, look, you're going to go and look at all these different possibilities. And then and of all those possibilities, we only want you to show us the patterns that you've recognized that meet those criteria. So what does that mean to you? Well, first of all, it means that you need to take all the trades, because that's the way the AI looks at it. It looks at it from big picture, big numbers point of view. That let's look at it this way. You cannot guarantee that every 10 trades that 8 of them are going to win. Maybe the first 10 trades, 4 will win. The second 10 trades, 9 will win. The third 10 trades, 7 will win. The fourth 10 trades, 2 will win. The fifth 10 trades, 10 will win. Over time, it starts approaching 80%. It's very similar to if you were to flip a coin. You know that if you flip a coin enough, that over time, you're going to come out really close to 50-50 on whether it's going to be heads or tails, assuming that, your flipping is truly random. But it takes the law of large numbers to approach these numbers. All right, so that's the first thing. Well, that's actually the second thing. The first thing I said, you got to trade small. You got to trade really, really small. You have to take as many of the trades as you possibly can, because the more trades that you get, the closer you get to the stated objective, the thing that the system itself is geared towards, and then it will achieve those numbers over time. Some people start off and they just hit it out of the park, 30 trades in a row. And actually this is happening because we don't have very many losers. In fact, since we opened the room in October, it's been more like 90% of the trades have been profitable. And our return on capital has been, really off the charts. And the last couple of weeks, things have slowed down. We haven't had as many trades because the volatility in the market has just all of a sudden contracted. So it's really a long-term game when you're playing this. And the more trades that you trade, the greater or the faster you'll get to that statistical target that we have. So that's the, is that the second thing? Yeah, I guess that's the second thing. And then I also said that you need to have like this, these tenets of trading, this sort of philosophy that, you want to preserve your capital. And that kind of goes along with the small trade size. Sleep at night. So when you start trading like this and you have this really great system that can give you quality setups and you trade small, you can feel really good because you can make consistent money and sleep at night, not worry about, even if there's like a market crash, you're not really worried. Now, how can that be? I mean, what if you do have a market crash and some of these things go way, way down? Well, here's the other thing. Our system is predicated on a number of different philosophies that we have learned over the years. I've gotten from my mentors and experience and other things that we've actually programmed into this AI. The other thing, and part of that, the primary philosophy, the primary strategy, the very high level strategy is one that has been adopted from hedge funds. Now, you may not know exactly, how hedge funds work from a big picture point of view. Hedge funds, what they do is they put on a number of trades, a number of positions, and each of those positions, relative to each other, have a low degree of correlation. And you think, oh, well, okay, what does that mean? That means that they all are based on different strategies. They all get their cues from different events and different indicators and different whatever. Therefore, they hit the market at different times. Their returns are not like correlated with each other. In other words, they're not all moving in lockstep with each other. They're on there for different reasons. And when they do this, when they have long and short positions, long, short, long, short, long, short, all doing it for different reasons. And when they have a very low degree of correlation between each other, it creates what is called a hedged position. That is that when some trades are going down and have a big drawdown, there are other trades that are on that are doing well at that time and maybe have no drawdown or are making money, and therefore diminishing the ones with the drawdown. Of course, this all requires that in the big picture, I gotta turn that thing off. In the big picture, that most of these strategies have a fair degree of consistency and they make money over time. They may not be very perfect equity curves where they go up like this, but they, like this, and they eventually go up. But when you take a bunch of strategies that are like that and then start melding them together and they have a low degree of correlation to each other, they start canceling out all that volatility and starts creating a nice smooth equity curve. So that's why we say that you need to take all the trades or as many as you can, because that's going to allow you to get to that law of big numbers faster. And that's how our strategy, our AI works. We have taken a number of different strategies, chart patterns, candle patterns, volume patterns, and other strategies, and we have taught the AI all of these things. What that means is that we have given it patterns for it to recognize. And a lot of them, a real lot of them. At the current count right now, it's over 450 of these patterns that we have given it from all different sources. And it will then look at these patterns, combine them with each other in many different ways. In creating new patterns, you can almost like look at it like that each one of these patterns is like a phonetic or a letter in an alphabet, but a very large alphabet, a 450 character alphabet that it puts together and then creates narratives, words, sentences, phrases, narratives of how a market behaves. And it can take these patterns and then find matches for them or similarities over decades of data. And so that is one of the predicates of our system is that it needs a lot of data. It needs big data. It needs 20 years or more of data. And it's one of the reasons why we're not doing Bitcoin, because it only has about 10 years of data. And it also comes from many different unregulated exchanges, and none of them really agree with each other on exactly on the price movement. So the Bitcoin data is very dirty, and it's very difficult for us to apply the AI. It's not impossible, but it's very difficult. That's why we don't do crypto. But when it comes to futures and Forex and stocks, we have clean data going back decades that our AI can then very quickly take these 450 phonetics, combine them in literally millions of different ways, and then quickly scan over decades of data and then find patterns. Find patterns that have similarity to the current whatever is happening today. And when it finds these patterns, we also give it other criteria. We say, look, only find patterns that produce some kind of tangible movement after that pattern has set up. And that movement has to be of such a degree. All right. So, and we make that our target. We may say something like that it has to set up this pattern, then it has to move a full standard deviation. Now, if you know statistics, you'll understand what that means. That means that it needs to move a lot. It needs to move more than its average movement over a period of time. And so, and then we say, okay, find those situations where that happens, and find those situations where it happens within a 5-day period. Those are the only criteria we give it. Everything else, the AI goes out there and searches for these patterns, these occurrences. And then it bubbles them up to us, kind of sorts them out, and then presents them to us, given our interface with the AI. It will, when we get those occurrences, so let's say we find this pattern and it clearly wins 80% of the time or hits the target 80% of the time, and over a 5-day period or within a 5-day period, we look at it. We look at the equity curve of it, its actual winning curve, the profit that it's made. And then we do a further examination on that. And we're looking for well-formed equity curves. What that means is that we want an equity curve that generally goes, but if it goes like this, and has like 2 trades out of, say, 100 that basically give 80% of its return, we'll eliminate those 2 trades, then look at it and see if it is still okay. And generally, when something like that happens, we throw those out because all the returns come from maybe just a couple of trades. We call those outlier trades, and we can't count on something like that. We want things that are consistent. And so that's a further paring down of these occurrences that we get out of the AI. And that's part of, us also knowing how to query it. And so then each day when we do a scan with it, we ask it, to go and look at all this stuff based on current market conditions. Can you find these patterns that match what we're doing right now? And because it has, it looks at so many different patterns, almost, and I think this is true up to this date, almost every setup that we have extracted from it to date has been different from every other setup. You think, well, you only have 450 strategies. How is that true? Because it combines them into literally millions, maybe even tens of millions of different combinations. And so when it finds patterns, it's a unique pattern. And remember I said before that to act like a hedge fund, to get the qualities of a hedge fund, which people and scientists have found is the most effective way of trading. It's more or less the holy grail of trading, and that is multiple non-correlated strategies. it delivers these to us, and then we then take those and, as I said, evaluate them and then present them to you in an email with a bunch of setups. Now, here's the thing. When you get this email and these setups, and I'll show you what they look like. All right, so here's an email. Oh, I'm not sharing the screen. Ah. So here's a typical email that was sent out just the other day. And then these are the setups. And you'll see that it'll have the symbol, what market it's from. And then the signal is the type of trade that it is, either a sell or a breakout. And I'll explain all this stuff. Where we expect it to hit in order to trigger that trade, and then the move that we expect it to make, or the exit. Now, where we expect it to hit and where we expect it to move to, these are not exact numbers, all right? I want you to put that out of your head. These are not exact. They're close, and they are what the AI saw that it should go to based on, looking at thousands of data points, that it should be close to that. But it's not exact. So if it misses by a couple of ticks, does that mean it's no good? No, it means that it missed by a couple of ticks and it's still probably within the 99% realm of possibilities. Same thing with the exit. But anyways, these are all statistically based. And okay, I lost my train of thought here. So this is what we send you. Oh yeah, here's the other thing I wanted to say. Of all the trades, all the setups that we send you, not all of them hit their entry points. In fact, a relatively small number of them hit their entry points. Only about 35% of them hit their entry points. Now you would say, well, you only have 4 trades setups here. If only 1/3 of them hit, that means that maybe 1, maybe 2 on average, 1.5 trades are going to hit. And that's true. But sometimes we put out 10 setups. Sometimes we put out none. On average, we get, I would say around 8 to 12 trades a week that trigger. We get, 30 or 40 setups that trigger, or the setups that we set out. And only a little over a third of them actually hit. Of those that trigger, 80% of those will be profitable on average. Actually, over the past 3 months, it's been closer to 92%. And 70% of them will hit the exit point, the target that they were originally predicted or forecasted to hit. Those are fantastic numbers. And so you would think that, man, if I'm just given all these great trades, how can I lose? How could I friggin' lose with this? And I'm here to tell you that if you do not follow the things that I talked about before, earlier on, that if you do not trade with position sizes that are small, if you overextend yourself, if you get too greedy, you will eventually find yourself on the losing side, even though everybody else is winning and you're wondering, why am I losing? Because you're too friggin' greedy. Because you thought you knew more. You made assumptions. And if you're old enough and you ever watched The Odd Couple and Felix Unger, and then that famous skit in the courtroom scene, when you make assumptions, when you assume, you make an ass out of you and me. That's where people fall apart. So we could have the best service in the world that throws out nothing but winners, and people could still lose. And that's true. That is absolutely true. It's crazy, but it's true. And that's why I spend most of this time trying to emphasize to you that if you want to be a successful trader, not just with this system or any system, you need to trade as small as possible. You need to have a systematic approach. You need to know your platform that you're trading on. And you need not to get greedy and trade small, trade smart. If you do that, it's almost impossible to lose. The problem is that for most people, trading is really hard because all of these things that you have to get in line are really hard things to do. In fact, well, first of all, just trying to get this quality of alerts is super hard. But we're taking care, that's the easy part. We're taking care of that for you. All you have to do is trade rationally, trade within your means, trade small, know your platform, get in, get out. That's it. Sounds easy, huh? Believe it or not, that's the hardest part for most people. Like I said, you could actually put the best trader in the world down at a desk and then sit somebody else next to him that has been a loser trader all his life and try to follow that trader. And guaranteed that guy is not going to do anywhere as good as that best trader. In fact, he may still lose. So that's essentially what we have here. We have the best trader in the world, the AI setups. If you could have a trader that could trade like the AI setups, they would be considered like top-notch, top shelf in the 0.1% of traders. So that's what you have. But when you put the human element into it, that's what screws it all up. All right. Let us now, I will tell you everything that I just said. We'll look at the presentation. I don't know if anybody has a question and whether or not I have impressed upon you how important this is, what I've told you. I mean, why else would I spend all this time telling you? Why else would I require that you take this training when you take our service? So we'll go a little bit over what I just said. The AI is a pattern recognition machine. It analyzes millions of learned and discovered. It actually learns its own patterns too. It finds patterns and it creates patterns. Learned and discovered patterns. It compares, classifies the pattern combinations over decades of data. It's big data. Identifies scenarios that are that have highly probable outcomes. It then filters those outcomes with specific boundaries. And those boundaries are within 5 days, actually 4 days after the trigger. So in other words, when we give you an alert, it's only good for 1 day for that session. After that session, you throw it out. It's no good anymore. You can't go back 2 days and say, hey, I remember that alert, 2 days it triggered. We're already moved on. And that they have 80% potential of profit and a 25% return on capital. Those are fantastic numbers. All right, that's what the system does. It trades futures, Forex. They are released at 8 to 10 p.m. Eastern time, the day before the next market. All right, so that means for futures, that means that they're released on Sunday evening, as well as Forex, for the next day and those signals are good until the session ends. Now, the session started on Sunday at 6 p.m. Eastern time and ended at 5 p.m. on Monday Eastern time. Then it goes to sleep. The futures market goes to sleep. The Forex doesn't. Its session goes from 8 to 8 around the clock. But futures, they stop at 5 p.m. Eastern time, go to sleep for an hour, wake back up at 6 o'clock, and then new session starts from 6 p.m. until 5 p.m. the next day. So that means that trades will be coming out, or AI setups will be coming out on Sunday night, Monday night, Tuesday night, Wednesday night, and Thursday night. The futures market closes on Friday at 5 and is asleep on Saturday and doesn't open up again until Sunday at 6. So it's a 23-hour a day market, 5.5 days a week. All right, where are we? We are here. Time frame and probabilities. This type of trading over a few days and holding things overnight, is most closely aligned with a style of trading called swing trading. This is not day trading, although within our room, we provide support within our trade room. Within that room, we do call out other discretionary trades every once in a while that are not part of the service, not part of the AI setups, but our AI mentor happens to be a fantastic day trader, and he may find trades that are in addition to all of this that are of such high quality that he may call them out. And so far, he's working on like a 95% win rate in those. So there are additional trades that may come up if you have the time to spend in the room. It should also be noted that just this past week was the first day in the room that we actually had a losing day. And it was a very small losing day, less than 1%, since October. So we went 106 days in our room before we had a losing day. Now, that is based on, all the things that I've told you. So again, setups are only good for the session which they're generated. If a setup is not triggered, then it is voided. So if it doesn't trigger within that session, we throw it out. We allow up to 4 sessions after that for the trade to achieve its target. After that, we throw it out. So there's a time stop too. So if a trade is triggered, we have a time stop. But what about regular stops, Ernie? Well, we have regular stops too, but we do not specify them. Instead, we tell you to figure out your own stops based on your total portfolio. You have to give these positions plenty of room. So, and also recognize that if you do it this way and figure out what your maximum drawdown could be in any period, any half year or year period, and then figure that to be your stop, then you're going to hit that stop maybe 1.5 times a year on average. This is what we figure. So if you figure out your stops based on your total portfolio loss, like where some people might think, well, I can only take a 2% loss. That might be way too small. First of all, you would never even hit 2% or whatever. But most people in a very small account might look at 10% as their ultimate loss based on their entire account. People with very large accounts, like $1 million accounts, might look at maybe 1.5% as being their maximum tolerable loss. But you do that not on each individual trade, but on all the trades combined. We call that a portfolio stop. And the reason for that is that that's another type of stop, plus our time stop, plus the fact that our risk is mitigated in the way the trades work themselves. Remember I said multiple non-correlated strategies, that they're hedged. They have a tendency to hedge each other. We might have, say, 3 winners on and 2 losers, right? And those 2 losing trades, you're not going to stop out of those because they might come back. And those 3 winning trades are mitigating those losses because it's hedged. This creates a very comfortable way to trade. If you focus on every single little trade and try to put your head in the weeds like that, that's not going to be good because you have to look at the big picture. This is what is so different about this style of trading and what a lot of people have a hard time with. They think that you have to put a stop on every single trade. Now, it's not to say that you shouldn't put a stop. Like what I do is I put like a ridiculously big stop that it's probably never going to hit it. And that's okay. I can always adjust it if I start getting a drawdown and then find out where my, because I'm trading small and because it's very unlikely that it's going to come down and hit that stop very quickly. It might take several days, maybe even several weeks before it hit that ultimate drop or whatever. I don't know. Or you have some calamity in the market. Because it happens so slow, I don't really have to worry about it that much. Hardly at all. Unless you're over leveraging yourself. If you're trading small, these type of things just don't happen that often. You can sleep at night with these trades. You don't have to be worried about them, even if they go against you, because there'll be 2 or 3 more other trades that you're putting on while you have that trade on. And you know that you're going to take that off within 4 days anyways, even if it's against you. Chances are that it will come back and make profit again. Like I said, it's been doing it 90% of the time in the last 3 months, 80% of the time on average over years. I'm sure that that percentage of win rate will fluctuate. It will probably go below 80% for a little while, go above it or whatever. It's an average. It's a very, very different way. And actually, this is the way that pros trade. Pros trade their portfolio. They don't trade each individual trade. Some trades you do. Some trades are just so unbelievably obvious that you get into it, boom, you take it there. And those type of trades, like I said, we'll call them out in the room. But the vast majority of trades, they're systematic trades that you just do. Boom, ba-boom, 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 like a drum beat. Boom, ba-boom, 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 boom. No trade is better than any other trade, except that some trades win more than others, which is kind of cool. Now, hopefully this is making sense to people. The target, all the targets that we are shooting for in each individual trade is a 60% historical probability that it's going to hit that target, or approximately 70%. That's why I said that 70% of the trades actually hit their targeted amount. Some go well beyond it, some go well short of it, but 80% of them will stay above profitability. If you're sitting there trying to capture every single tick and then stopping out of this one and then jumping back in here and then stopping out, yeah, that's not going to be good. As you get, now the big difference between smaller accounts and bigger accounts is the flexibility at which you add to a trade or put positions on. With very small accounts, you don't have a lot of flexibility. You have to choose just the smallest position size you can and deal with that and then get out in the allotted time. With big accounts, you can scale in and scale out of positions around those probability areas. All right. And of course, everybody hopes that they can get to big someday so that they can scale in and scale out of positions. As a newbie trader, you don't have to worry about that. However, inside of our trade room, if you do have a bigger account, we have our AI mentor, that's my partner, and he's providing constant support and mentorship inside the room, helping people with both small and big accounts, as well as everybody else there kind of supporting each other. So it's really a good thing. All right, let's, we already did this. We looked at that. This is what the old setups used to look like. We used to send out a spreadsheet. Now we just send it out in mail. Here's one that happened not too long ago. Let me look at this. There were, what, 1, 2, 3, 4, 5, 6, 7, 8, 9 setups that happened. Out of those 9, about, I think 4 of them actually triggered. So those are 4 trades in a day. So you could conceivably have at any one point in the course of a week, 4, 5, 6 trades on. Some are long, some are short, etc. Now let's talk about these different trades. Oh, I'm not showing this, am I? That's what I was showing. This is what old setups look like. This is what new ones look like. The email. We used to send out a spreadsheet, and then we went to an email format. This is an email, right? I showed you one earlier. That's an email that just went out just the other day, on Thursday, I believe. So let's take a look at what we're seeing here so that you get a very good, clear understanding of how to read this. There are three basic type of trades. There's buys, sells, and breakouts. So those are the scenarios that the AI is uncovering for us. And then they could be different markets, Forex or futures and equities, although we don't have that many equities trades out right now. We will in the future. And then the symbol for, what contract it is that we're trading. Now, I'm not going to get too heavy into the contract stuff, other than to tell you that with Forex, everybody should understand the Forex. They're pretty universal in the way they're presented. However, there are some differences from one platform to another, and I'm going to show you those. And that's really the biggest part of this service is everybody has a different platform, and that's why I said in the beginning that you need to become a master of your platform. You need to be just this sort of stoic, take every trade like it's just another trade, and then understand how to execute. If you can do that, you can do really well. I am just bringing up something that I need to show you. So, so the symbols, the Forex symbols are pretty standard, but depending on what platform you have, and we try to cover, three example platforms that cover, 80% of most people. And that's Thinkorswim, TradeStation, and Interactive Broker. But I'm sure you may have a different platform. That's okay, but it's probably very similar to Thinkorswim, the way it presents symbols for the different contracts. For Forex notation, you'll see right here in the middle the differences on the Euro USD Forex contract. TradeStation just has it, EUR USD. Thinkorswim puts a slash between the two pairs. Interactive Broker puts a period between the two. Right? So that's a difference in Forex. On futures, there's a lot of difference. On futures, you can see the futures ones. All these futures symbols come from TradeStation. That's what we send out. But not everybody has TradeStation. You may have Thinkorswim or Interactive Broker or E-Trade or something else. Chances are, if you have something different, that it's probably going to follow the Thinkorswim format. And that's why we provide you with this spreadsheet, that it provides a cross-reference. Because on the right-hand column are the TradeStation symbols, and those are the ones that come out in our alerts. And then it provides a cross-reference to Thinkorswim and Interactive Broker. Thinkorswim is probably going to be more similar to most other trading platforms out there, because they take the symbols almost literally from the CME group, where all these futures contracts are, the CME group, they're the exchange that is the home for all these futures contracts. It's the biggest exchange in the world, way bigger than any other exchange. It is worth, the daily trading volume on the CME with all the different futures contracts is probably up around, it's probably a $30 trillion market. So they define things in a certain way, and Thinkorswim really follows their format. But because you might have a different trading platform, and our AI mentor who's extracting these off of TradeStation knows TradeStation, we provide you with this cross-reference. Now, these are all the contracts that we've traded since we started the service. As we go on, you'll have this spreadsheet. If it doesn't appear here, you can add it on to here if you want. And then I continually update it. So you can see that, for instance, the Aussie dollar, well, let's look at the euro dollar, the euro USD. There is a futures contract that is equivalent to that for the euro. And but that's different than the Forex. They're two different things. The Forex is the actual currency. The futures contract is the derivative that is playing the futures of that Forex currency. But we trade both different, they may have different price patterns and strategies. You may even have a time where we're going long on the Forex Euro USD and going short on the futures Euro. That's very possible. It's happened several times, things like that. And that really tells you that I'm serious when I say that we're long, short, long, short, long, short. We have different strategies that are uncorrelated with each other. They get triggered by completely different things. And that illustrates that overall we are putting out trades that are uncorrelated with each other, that are essentially hedging your overall position. And hedging is like I said, it's like the holy grail of trading. That's how hedge funds and big institution banks, that's how they make their money. They do pairs trading and hedging. Most retail traders don't do that because they don't understand it. They don't know it. And here you don't have to know it or understand it. We just give you the trades. So anyways, getting back to the format. So when you go to your platform and you plug one of these symbols in, they're typically going to give you what's called the front contract. All these contracts have expirations, and they're different. Like energy contracts go month to month. Currency and index contracts go quarterly, typically from March, June, September to December. And sometimes when you're like on the border of when one contract is going to expire and another one's going to come up, you want to make sure that you're in the right contract. Very rarely do we put out a setup that is just changing from one contract to another, but it's happened. And so it pays to know, what is the front month contract, and that your platform is giving you the same contract that we're talking about, because the pricing can be different from, say, an oil February contract and an oil March contract. It's important that you're trading the same contract that we're putting out, because that's the contract that we're referring to, not the one in the future. Which is kind of interesting that you can trade these contracts. You can even trade an oil contract. You could trade, if you wanted to, an October 2019 oil contract today if you wanted to. There wouldn't be a lot of volume in it, but you could do it. In fact, a lot of people in the industry, that's what they do. They'll trade the oil October contract against the March contract. It's called a calendar spread. But we don't do that. We don't do the same contract but different dates. We are always showing you the front contract, the most recent contract. And the best way I can explain this is that your platform will serve that up to you. That's the one that they'll serve up to you, and more than likely it will be the same contract that we're talking about. But what I'm trying to emphasize to you is that you should know enough about futures contracts to know the difference between one month and another and which one is the front contract, and check it, right? Make sure that you're putting on the right contract, and you can usually tell it by just looking at the price and the price that we specify. You can say, oh, well, you specified this price, but this price is way different. That's because it's probably a different month. See, I don't know if that conversation caused any um, any questions. But don't worry about this, right? Because it's not like a big deal. I'm putting it out there because it's important that you know. Of course, we're um, in the trade room on our Discord server there to help you at any point. We provide one-on-one guidance. Other people will be there to help you. Other people that are trading the same platform that you're trading will be there to help you. And in the space of a week, you become an expert. But what I'm going to do now is I'm going to talk about, so that's the whole deal with symbols. Now, of course, the full symbol for any contract is more than this, more than what I was showing. There's a month that the contract expires, and then there's the year. So let me just show you what that might look like. See, do we have that in here? So sometimes you'll see, like, for instance, the oil contract right now is in February, and you'll see it will say CLG19. And then you'll see that there's a code, a month code that happens on most contracts. Let's see. We can do this by taking a look at Thinkorswim right now. And so I'm going to stop sharing here, and I'm going to share my Thinkorswim window. So here's Thinkorswim, and I have a whole bunch of different things in here. And so, for instance, right in this top middle one, let's make that bigger, is oil, crude oil. Crude oil has been going up. And if you look at the symbol up here in the upper left-hand corner, it's /CL. Now, it is more than just /CL. If you look very, very closely right next to it, it says light sweet crude oil futures, March 19. Right? So it's kind of hiding all the other information and just giving us what's called the continuous contract and showing us, but it's showing us the March 19 data. It's not showing us the February data. It's not showing us the January data, even though we're in January. It's showing us the March contract, which is the front contract. How do I know it's the front contract? Well, that's the contract that most traders are trading right now. How do you know that? Well, the easy way to know that is to go to the CME group where these contracts live. Let's go to the CME group. This is all just for your edification. It's not like you have to be an expert at this, but you should try to be an expert at anything that you trade. You should understand the contracts and everything. But here we can, I've gone to cmegroup.com. I'm going to go to the trading tab and then to energy. This is where I'm going to find things like crude oil and heating oil and natural gas. All right, so there's crude oil futures. And then these are all the specifications for crude oil. You can find this with just about anything that you're trading. And I'm going to look at the volume on crude oil futures. This is the volume for all the different contracts that are currently on the table right now. You'll see that January is already off the table. It's not even listed here. February is here. And then here's March. And then April, May. And you can see you could trade all the way out to, wow. If you wanted to, you could trade all the way out Can you imagine this? To 2022, December. You can even go, there are some people that have bought December 2023 contracts. That market's got to be pretty thin. But if we look at March, it is by far the heaviest volume. When you see one that is just by far the most volume, that is what's called the front month. And anytime that we're putting a trade out there with a futures contract, that's the one that we're trading, the one with the most volume. Now, of course, oil has a lot of contracts, and so, might get a little confusing, but that's not confusing at all. That 669,000 is way bigger than 193,000 and way bigger than 92,000. It's pretty obvious that the March contract is the contract that we're trading. Of course, your trading platform will serve that up to you right automatically. It'll know that that's the front contract, because that's what most traders do. They trade the front contract. Now we could go back and look at, say, equity index futures, like, well, let's go to the euro. We'll go to, because we were looking at the euro before. They're quarterly contracts, not every month. So here's the euro FX futures contract that we were looking at before, that was called EC on TradeStation. And here we can see they don't have so many contracts open, and you can see, well, they don't even do, let's see, they don't even do those. Let's go to volume. Now, currency contracts don't actually trade February, April, and May. They only trade March, June, September, and December. They have these other contracts here for other special purposes, but it's very clear to see that the front contract is March. I mean, I don't think there's anybody that will doubt that the front contract here is March because of the amount of volume. Let's take a look at equities like the E-mini S&P or the Dow or the NASDAQ. Here's the E-mini S&P. Let's look at the volume of that. Now here you can see that these are definitely quarterly contracts. Only March, June, September, and December are actually there. And March, by far, is the overwhelming candidate for front contract. All right, so there's your lesson on how to find the front contract. It's really all you have to know. All right, there is a question. Have you had trades where the fourth session span of a triggered setup overlaps with the contract expiration? Yeah, we have. We typically get out of the trade before that even happens. Or if the trade comes up and we find that it's going to expire the next day, or it's going to expire that day, we'll just ignore the trade. But your platform won't automatically roll it. That's something manually that you have to do. But I wouldn't worry about it. We avoid those situations. We just don't deal with it. It's not worth our time, because every trade is just another, brick in the wall. Trudy's saying, I have to decide which broker to go with. I live in Canada. Well, I don't think TradeStation will be available to you. Thinkorswim or Interactive Broker will. There are some cases where some people from Canada I know have United States addresses, and then they'll use that. All right. So the next thing we're going to talk about are the trade types. I have to share the screen again. So again, here are our trade types. We have breakouts, sells, and buys. What does that mean? Well, here's where this is what a buy signal might look like. So this is showing the Swiss franc on Thinkorswim. And you can see the price is currently at 1.014. But the alert comes out, says buy at 1.012, which is below that. You know, it's below that by many ticks. Even though it looks like only 2 ticks, that's actually a lot of ticks. There's a lot of smaller ticks in between there. The buy is down here, and the target in the or the exit that comes in your mail might be way up here. Now, will that price come down there and hit there and then give you an opportunity to get in and then go long? Maybe. 35% of the time it does. Now, a buy will usually be well below the current price. And so you have to wait for it to get down there, and then you set a trade up. Now, there are 2 different ways that you could set that trade up. One way is that you could be waiting for it and then just put in a market trade, which will put it in at your discretion. When you press that button, it will take the best price that it can when you're around that price. I do that. That's the way I trade most of the time, but not everybody trades that way. Most people don't trade that way. I usually wait to see if it will drop below, and then I'll hit the market trade and get a better price. Most people, what they'll do is they'll just set up what's called a limit trade, a buy limit trade. Some people call it a stop loss trade or whatever, and they'll just put it into their platform that says buy when it hits this level. So it will only buy it if it hits that level or better. Or in other words, if it hits that or goes below it, and then it will take the best price that it can get below that level. And then they'll set up another trade, maybe conditional upon that one getting in the trade, to exit, to do another stop, to do a sell limit at 1.018. Now remember, only 70% of them reach there. There's another percent that never reach there. So by putting that up there, you're taking a little bit of a chance that it may not reach there. You're also taking a chance that it may go beyond there, but that's okay. Some people try to take at least 75% of the trade where there's a much greater chance that it will reach. Some people hold on to it, and depending on the size of your account, might take half of their position off and let the rest ride up. If you have a very small account where you only have one contract, that's not possible. So there are a lot of ways to do that. So, but the case here is that you're on a buy signal, you're doing a buy limit order. On a sell, you're doing the opposite. You're doing a sell limit order. You're waiting for it to come up and hit a target and then come down. On a breakout, you're doing something different. Here's the example of a breakout. You're below a level, and it has to come all the way up to it and hit that, and then you're expecting it to take the trade right there at that level and then go through it. You might be thinking, well, why don't I just take the trade down here? Because you don't know if it's going to come up and break out. And that it's only triggered if it does break out. That's the whole point. That's when you take the trade, when it breaks out of that level. For that, you put on a type of order called a buy stop. Now, a buy stop is like a combination limit order and market order all wrapped up into one. So as soon as it hits the price, on the way up to hitting the price, it's a limit order, but as soon as it hits the price, it turns into a market order and then just buys at the best price possible. All right, so there's the 3 different types of orders. I already showed you the spreadsheet. Now there's another part of that spreadsheet that I want to show you. Let me get the spreadsheet. Remember I said that, you know, you want to trade as small as you possibly can. And some of these futures contracts may be prohibitive to you even trading them. They may have more margin than you can handle. And that's okay, because there are different options that you have there. One of them might be options. You can actually trade options on futures contracts. But another is that there are micro versions of a lot of the currency futures and some of the energy and precious metal futures. And so I have another tab here that shows the micro versions of these contracts, which are 1/10 the size of the regular contract. So that might be one of your options. You could trade one or more of these contracts in place of the full-size contract. On Forex, if you've traded Forex before, then you know that there are basically three different sizes that you can trade. You can trade standard size, which is roughly equivalent to what most of these futures contracts is, anywhere from, say, $2,000 to $6,000 worth of margin required in your account. You can also trade a mini size, which is 1/10 of that, and a micro size, which is 1/10 of the mini. So with Forex, you can trade really small. So in other words, if you had put on a full-size Euro USD contract, it might take up, say, $4,000 worth of margin in your account. If you trade a mini version of that, instead of 100,000 units, you're only trading 10,000 units. It only takes up $400 of margin. You could trade 1,000 units, which is a micro size of that, and then it only takes up $40 of margin. So with Forex, you have even more flexibility in terms of trading small than you do with futures. But you do have, let's say that you wanted to trade some of these that don't have micro versions. What do you do then? Well, what I've done is I've created another spreadsheet here, and I haven't filled all these out yet, but the other option is that you could go to ETFs that have that are equivalent to a futures contract. And there are ETFs for virtually every futures contract. And you could figure out how many shares would be equivalent to one futures contract and then just trade, you know, far fewer shares, trade 1/10 the number of shares. And then you would be trading an ETF that will have approximately 1/10 the buying power of that futures contract. That's because these ETFs are actually using the underlying futures contract underneath there to create that ETF. Now, I didn't fill them all in. I just started this for you, figuring that most people, it would be a good exercise for people to go in there and find out which ETF is equivalent to which futures contract and how many shares would be equivalent, so that you can figure that on your own. I like to give people a lot of information, but at some point they have to learn. So I don't give it all there. All right. So I've given you a lot of information here. And all of this information is, you know, what we consider the primary information. A lot of it is geared towards, you know, how you put on trades. What are the differences from one platform to another? And most of it is really geared around figuring out your platform, how to put the trade on, you know, how the notation of a futures contract or a Forex contract is on your platform, so that you can translate. Now, if you're using TradeStation, you just use the exact same symbols. If you're using Thinkorswim, then you have the spreadsheet to translate. If you're using Interactive Broker, you have the sheet to translate. If you're using another platform that has completely different symbols, which is highly unlikely, it's probably very close to Thinkorswim, then you can use that or fill in your own column. But once you're there and you've decided what's the right size for you to trade, and again, we can provide you help with, the size that's appropriate for your account and what your personal tolerance and capacity for risk is. And then we can show you an appropriate size. It's probably a lot smaller than you think. Once you get all that straight, then it's just a systematic approach. You get the alerts, you set them up, you wait for them to trigger. If they trigger, that's great. You watch them. If they don't trigger, then you make sure that those orders are cleared off your book. A lot of people, what they do is they'll set these up the night that the alerts come out, go to work, look at them a couple of times on their phone, and then monitor it. And if they have to, they can make a trade right on their phone. All right. A lot of times they don't have to. They can wait till they get home and maybe deal with it later that night, or they already have a trade set up and it does it automatically. Some people like to sit in front of the computer and be involved with the trade group all day. They love that camaraderie. And they also like the extra trades that the AI mentor provides, the discretionary trades in the room. They also want, maybe a little bit more hand-holding and understanding, and so we provide that as well. We are going to be coming out with a series of webinars, instructional webinars that will be, paid training classes that will cover things in much more depth for some people. And so the AI mentor and I, my partner and I, are going to devise a number of different training classes, very similar to how I've done my volume profile courses. I don't know if any of you have ever taken the volume profile that I offer. But I'm going to start offering that as well as other courses that we're going to develop that are all kind of geared towards helping people become the best trader possible. I mean, as I said earlier, one of my mentors once said to me, trading is the hardest way to make easy money. What he meant by that is that trading really is easy to make money if you have gone through and done all the hard work up front to understand your platform, to develop the discipline, to know where your risk really lies, what is an appropriate size position for your account, right? Once you have all that settled, and then you just follow the alerts in a very systematic, very robotic way, the money part is actually quite easy to make. It's when you try to second guess everything and do a little bit more, get a little greedy. That is ultimately where 90% of people screw up in trading. So that is the, so we've gone in, we're about an hour and a half in. That is the conclusion here. Actually, more like an hour and 20 minutes. That is the conclusion of this training. And if you have any questions, I'm going to leave, however much time that you want to ask them now. Trudy says, yep, got screwed me up in MJ stocks. Probably because you just overcommitted. And probably didn't have a good strategy for when to get in and get out. That's the other thing. We're giving you that. Get in, get out. Get in, get out. Don't get married to a trade. Go on to the next trade. Can we look at your spreadsheet on the PowerPoint with the position sizes? I don't have position sizes. Position sizes, I do have one. Let's see, what do I have here? I have an example thing that I use sometimes. Let's just look at that. So I've created something like this here that shows an account size on the left, and then the amount of percent of that account on the top, and then in dollar amounts what that equals. And then I just split it up into different sectors. And then, you decide where you want to be. I'm not telling you where to be, but I'm telling you that, for overall catastrophic loss in your account, typically that is somewhere between 4 and 10% for most people. All right. So now you can see how much that is in each different size account. And that's generally what I tell people, that you want to set your time stop and a catastrophic stop for most trades. There occasionally will be some trades that really go off the edge, and they're obviously that they're not going to come back, and then we get out of them. That happens every once in a while, very rarely. But here you can decide, what is your catastrophic stop. And so if you have, say, a period of a week or two where things start drawing down, it gets to a point where your portfolio is down 10%, and that's the max that you're willing to do, then you stop out of things. All right? Don't allow them to get any worse, and then maybe readjust your position size and then get back into it. Regarding Forex, Matt's asking, the alerts come as full contracts. How do we find the equivalent mini and micro contracts? Not on Forex, no. So for Forex, that's completely up to you how many shares that you actually choose on your platform. You probably didn't know that, but you can set up your platform to trade either 100,000 units, 10,000 units, or 1,000 units. It's virtually that way. And some platforms don't allow you to go below a certain amount. Interactive Broker defaults at 2 mini units or 20,000 units. I don't know why, but they do. Some platforms default at 100,000 units, which is a full-size Forex contract. Now, on futures Forex, futures currency contracts, I give you the spreadsheet that shows the equivalent of a micro and a regular size. What's been the biggest loss and the biggest win percentage so far on a single trade from the AI? It's got to be either heating oil or the Aussie dollar. We had one with the heating oil that made about $3,400. And with the Aussie dollar, we had one that drew down about $1,800, but then it came back up and then won, believe it or not. But it might have drawn down enough where some people were, freaked out by it and then got out. But if they held on for another day or 2 days, it actually ended up being a big winner. We haven't had too many big losers, 1%. Right, so Matt's confirming on IB that the default is actually 2 mini contracts of 20 units, or 20,000 units. I don't know why they do that, but they do that. That's what they do. TradeStation doesn't do Forex anymore. So if you do TradeStation with futures, you're going to have to find another platform to trade Forex. Interactive Broker does everything, and so does Thinkorswim. I'm surprised we only had 12 people show up today. Actually 11, because Trudy's in there twice. We had 19 people sign up. Normally we get about 80% of the people. So that means we need another 3 or 4 people, but that's okay. Any more questions? Of course, you know, everyone knows that they can contact me or the AI mentor anytime through Discord or through my email or call me. You can find my all my information on my website. If you go to the About link on my website, all my contact information is there. One thing that we're really trying to focus on here is a high degree of support and quality of support. Well, we don't send out Forex and TradeStation ticker names. We just send out, you can use them anywhere. The only thing we send out are futures on TradeStation. TradeStation still allows you to chart Forex with real-time data. They just don't allow you to trade it, by the way. So we can actually do some of that. We actually get all the data from TradeStation and then put it into the AI. Because their data is by far the highest quality of most of the brokers and the easiest to extract. Costs a lot of money to do it though, because we have what are considered professional accounts. We pay for that data. So it doesn't sound like anybody else has any questions. Well, that's great. So that means that, can you explain again how to manage catastrophic stops in terms of the portfolio? Yeah, so let's say that you have a $25,000 portfolio and your catastrophic loss is, I don't know, 15%. Let's say it's $3,000. That on your 25,000, you're not willing to lose more than $3,000. Then what you would do is you would simply set your trades or have an alert on your account size if it drops below $3,000. Or you can set a limit on certain trades that might cut them off if they go below that amount. It's pretty much like that. It doesn't have to be automated. It can be automated. There might be some platforms that can, you know, get you out of all trades if your account goes below a certain level. But generally, it's something that is more, you manage more discretionary, you know, manually. And that's generally the way most people play it. So, like I said, it's very different from the normal way you've probably been taught to trade, where you put like stop losses on everything. On some trade, you might want to still put stop losses, but put really, really loose ones, just in case that you have, you know, just a massive drop or something, but way bigger than you possibly ever would have imagined. Because like I said, that most of these trades will even each other out because of their hedging nature. What is a comfortable amount of cash to start with? Minimum, I'd say 10,000. We have had one person that started with 7,000 and actually did quite well and doubled their account. I would say that you have to make a lot of compromises at that amount. 10,000, it gets a little easier. Obviously, the more, the better. And, you know, you could go this strategy actually works well for any size account. The only thing that you change is the things that you trade to try to get the position sizing as small as possible relative to the account size. When you start getting bigger and bigger accounts, instead of having to try to get and pare everything down, then you're figuring out how many contracts for each thing that you would put on. Like if you had a $500,000 account, you're not thinking one contract for every trade. You might be thinking 4 or 5 contracts for a trade. Maybe a little smaller, maybe a little bit bigger. I don't know. The key seems to be trade small so you can sleep at night while still on the coaster ride one way. Yeah, that's pretty much it. Trade small and trade systematically. That's it. I mean, it is, like I said, it's the hardest way to make easy money. It's if you figure out how to get all that stuff in line and just be systematic like that, then the trading and making money starts getting really easy. But most people don't see that. They want to make money right away, or they start making money right away and they want to make more money. And that's usually where they screw up. I mean, not usually, it's almost exclusively where they screw up. Or they can't figure out when to get out. They're always on the fence. They don't know, they let something ride up to a target and it doesn't hit that target and they don't take anything off. And then it goes all the way back down. And then they're wondering, oh, what do I do now? It was a winner. Now it's down here. So, well, why didn't you take it off there? Well, it didn't hit the target. Yeah, but it came within a few ticks. That's Trudy. So you have to look at stuff like that and say, man, if it goes up halfway, I'm going to maybe put a stop loss in there, so that at least if it comes down, I'm going to make something. And that kind of goes away from my idea of stop losses. But if it's already profitable, then why not keep the profit? Or maybe put a stop loss a little bit above the entry point and give it a chance to go up. There should be no excuse for taking losses when a trade was in a winning position. Of course, if it's only a slight winner and then goes down, I mean, that's different. I'd want it to go up at least 50% of the target or more before I put a stop in there and protect the gains. Depending on how volatile the market is and depending on, how fast it went up and stuff like that. You're welcome, Matt. All right. Anybody have any more questions? Can you talk a little bit about margin requirements? Well, margin, I mean, when you're trading Forex or futures, and even when you're trading most equity accounts are margin accounts. You're trading on margin. When you're trading futures, you have no choice. You're trading on margin. There's a certain amount of margin that is associated with each contract. And so that is the amount of money that will be locked up or tied up in your account when you put that trade on. And so it will be unavailable if you have let's say you have an oil contract on. Let's see, what is the margin on oil right now? The margin on, for instance, the E-mini S&P right now is about $6,000, I think. So for some people, it might be prohibitive to even put on. Yeah, it's $6,000. The margin for treasuries is much smaller, like the 10-year. Let's see what the 10-year note is. Hold on. The margin on a 10-year note is $2,500. So you put it, if you had a $10,000 account, you put $2,500, you have $7,500 left. right? You might be able to put another couple of trades on, that's it. Or if you put on a Forex trade, you can put on a micro position and not use much more. It really all comes down to you evaluating the amount of margin that you want to use based on the size of your account. And you want to try to keep that ratio small. The Trudy, what you're saying, you traded Aurora, went to 9.99. I didn't sell, and it went all the way down to 8.15, and you're hoping that it will go up again. I don't think it's going to go up anytime soon, to tell you the truth. That's my opinion on marijuana stocks right now. That's right, Iceman. You never get emotional about the trades. Trade small, and every trade just seems just like another day at work. You know, you get through that day, go to the next day. Get through that that event, go to the next event. Don't get married to any individual trade. You put it on, either it works or it doesn't. If it works, great, get in, get out. If it doesn't, that's fine. Get in, get out, go on to the next one. All right. Any more questions? If you haven't, now I'm going to send out an email, and there will also be an invite there if you haven't already done so to our Discord trade room group. I highly recommend that you go there, and I send out emails reminding people of this all the time. It's an invaluable resource. So I want to thank everybody for showing up. I'm going to stop the recording right here.